Welcome back to TalkTickers. Today we are jumping right into Stewart Information Services. They just dropped some really impressive Q2 numbers for 2025, and we're going to break it all down for you.
All right, so let's get right into it. Stewart just delivered a quarter that frankly blew away expectations, and you can bet investors noticed immediately.
So, first up, let's look at the top line. We're talking revenue of $722.2 million. Now that's a nearly 20% jump year over year. And get this, it completely smashed what the analysts were expecting by a solid 7 to 8%. Just a huge beat.
And you know, as good as the revenue was, the bottom line was even better. I mean, check this out. Adjusted earnings per share hit $1.34. That is a staggering 48% increase from last year, just way ahead of what anyone on the street was projecting.
So, what did the market do? Well, it didn't waste any time. The stock absolutely soared. We're talking more than 10% the very next day after they announced these numbers.
Okay, so here's where the story gets really interesting. Because these incredible numbers, they didn't happen in a vacuum. They happened smack in the middle of a really tough housing market. And that, of course, raises the big question.
I mean, to say the backdrop was bleak is kind of an understatement. You had the CEO, Fred Eppinger, literally calling it a stubbornly challenged housing market. He said the whole spring selling season just fell flat. You've got high rates, affordability problems. Basically, buyers were just staying home.
So how on earth did they do it? How do you pull off a quarter like that when the entire industry is facing these massive headwinds?
Well, the answer, and it's a really smart one, is all about diversification. See, Stewart isn't just a one-trick pony focused on residential titles anymore. They've got these other business segments, and man, they were just firing on all cylinders.
And this right here, this chart really tells the whole story. You can see their strategy paying off in real time. Look, the residential side of the business, pretty much flat. No surprise there. But then you look at commercial, agency services, real estate solutions, just explosive growth. It didn't just compensate for the flat residential market, it blew right past it.
Let's dig into these numbers a little bit because the execution here is just fantastic. That 46% pop in commercial, a big chunk of that came from the average fee per deal jumping 25% to almost 17 grand. That's huge. And it's not just that. Their agency network is gobbling up market share, and their real estate solutions business just keeps getting bigger.
Okay, so that's the what. Now for the so what. What does this all mean for investors? Well, this quarter actually lays out a pretty clear thesis for how to think about this space going forward. For us, what this performance screams is a classic pairs trade. You go long on a company like Stewart, that's STC, and at the same time, you short a company that's only in the residential mortgage game. The logic is pretty straightforward, right? Stewart's diversified model is like a fortress right now, built to withstand these high rates. Meanwhile, those pure play companies, they're just completely exposed and vulnerable. And the bull case for Stewart specifically is just really solid. First off, it looks cheap. The PEG ratio is around 0.3. I mean, anything under 1 is usually considered a good deal for a growth stock, so this suggests the market hasn't fully woken up to this story yet. On top of that, their balance sheet is a fortress, and they're just executing like crazy. Look at the cash from operations. It more than doubled compared to last year. That's just beautiful. So, you add it all up, the incredible execution, the brilliant strategic positioning, the momentum they've got. For all those reasons, we're putting an outperform rating on Stewart Information Services.
All right, and before we wrap up, just the usual but very important disclaimer.
Please remember, none of this constitutes financial advice. Everything we've discussed is purely for informational purposes. You've always got to do your own due diligence.